So you're with us here in Closing Bell, 35 points on the Nifty, 10,806 is where we find ourselves at. We've been talking about how the public sector bank space has been doing well, corporate banks. I mean, there was ICICI Bank, there is Yes Bank, which has joined that list of things which is doing well. Pharma, I mean, Sun Pharma, top of the list as far as the Nifty is concerned. And then you kind of sort of trail off. Autos have not been doing all that badly, especially put in contrast to what we've seen in auto stocks now over the last 8-10 trading sessions. Sudeep Bandyopadhyay is Group Chairman of IndiTrade Capital, who's now joining us. Sudeep, good afternoon. Thanks very much. Prashant here. Just a quick word on what we are seeing on private banks, corporate private banks. I mean, there is another leg higher. ICICI, for example, at a new 52-week high. What are your thoughts, Sudeep?
Well, I think, Prashant, this was on the cards, and I have been talking about the same in your channel for quite some time. Last quarter, when ICICI as well as SBI and even Axis announced their results, I think from the commentary of the management, it was pretty clear that they have done with the kitchen sinking. Pretty much all the bad news has already been factored in, and with NCLT recoveries now in the horizon, I think things are going to improve from there on, and that's pretty much what has happened, and that's how it has played out. But having said that, Prashant, I would like to put in a word of caution. I think it's moved up quite a bit, whether it's ICICI or Axis or even SBI, it's moved up quite a bit. So while things have improved or are going to improve in these corporate banks, prices also have moved up. So if somebody really wishes to take exposure in private bank now, probably I will recommend them to look at smaller private banks which have also significant corporate exposure. I can name Federal Bank. I think it's a good bank, and pretty much the same set of kind of principles should apply there as well. And investors can look at buying into a Federal Bank or some other smaller South Indian banks like City Union Bank.
I think with Federal Bank, one refrain I constantly hear is return on equity is not what it needs to be for the stock to do well. Sudeep, I mean, all other parameters, I mean, maybe in terms of asset quality, etc., absolutely up there, doing very, very well.
I agree with you, Prashant, there. I think they need to kind of beef up their act as far as that part is concerned. But if you really look at the relative valuation where it is, we believe that 120 kind of level is the right valuation for Federal Bank at this stage. Yes, they need to improve significantly, but having said that, I think the quality of management is top class there. They've been doing the right things. The legacy corporate book has given them a lot of trouble, but I think, as I mentioned, most of the corporate banks, they are done with the kitchen sinking, and I think things are improving even at Kerala. They also kind of got hit because of the Kerala floods, etc. To a great extent, it was based on rumors and things like that.
Yeah, the stock got hit, the business was absolutely fine.
But
yeah,
I think,
as you say.
Absolutely, absolutely. So I think things are improving and investors can look at it. Yes, they need to do something more about the return, definitely.
Okay, all right, Sudeep, stay on with us. We have more questions coming up for you. But right now, as promised, let's get you a slice of opinion that we got from Nilesh Shah of Envision Capital. With the Q3 earnings season kicking off, we asked Nilesh what his expectations were from the third quarter and what were his top sectoral bets at this point.
I think the earnings is going to be good from the tech biggies, especially the big players. Clearly, I think the growth momentum is still there. Volume growth should be good. Clearly, for the year gone by, and I think the outlook still on the technology side is still kind of very robust. They have a strong tailwind of the currency as well. So I think on the whole, I think they should be set for either high single digit or a low double digit kind of an earnings growth. The street is more interested in knowing is how's the calendar year looking rather than how just 1 or 2 quarters are looking. And I think that's going to be very, very important.
Auto stocks pricing in way too much pessimism. Is this a buying opportunity or is this a real slowdown threat?
No, it looks like that the slowdown threat is for real. Okay, I think, of course, the industry and I think most players have been talking about some kind of a liquidity squeeze and the NBFCs not having funding, and therefore that's impacting demand. But I really don't think so. I clearly believe that there are banks out there who have enough liquidity to lend. I think there is a slowdown. That's the reality. Clearly looks like that they could have maybe another quarter or two of a slowdown. Of course, in between, if there is any kind of a fiscal stimulus in terms of, say, for example, GST rates being cut on automobiles or two-wheelers or all of that, that could trigger some kind of buying demand. But otherwise, if that doesn't happen, then I think we'll have to be content with the kind of current performance of the auto guys.
Therefore, how will you grade up in terms of the other consumption stocks? I mean, staples, they are the performing stocks.
From a pure fundamental outlook, I think the consumer staples as a sector is safe. Okay, I think clearly they will kind of still grow at about close to 10-12% volume growth, and I think that's pretty robust in an environment like this. However, as investors, the challenge in consumer staples are valuations.
Always answered by saying that I like the retail guys, the private retail guys. Any change to private corporate or some of the... No change?
No, absolutely
They've done
not.
so well, Axis, ICICI,
Yeah,
not convinced.
they've just caught up. But I think because the bigger challenge out there is you really don't know how are things going to really yet shape up in terms of asset quality and all of that, number one. Number two, leadership change. I mean, these are finally services businesses, and in that, clearly the CEO, the leadership essentially matters quite a lot. So I think it would probably still be better to kind of see for a quarter or two how really the new leadership changes. In the meantime, you also have choice where there are banks which are giving you that fantastic quarter-on-quarter growth. There is strong visibility. Valuations are not totally out of whack. So I still believe that that's the space to really watch out for.
Rural India is going to be pumped with a lot of cash, whether it's a waiver or a largesse of some sort. How do you play that?
First of all is we strongly believe that there's a case for rate cuts. Okay, and I think that's something which can happen, number one. And number two is I clearly believe that I think the street will wait for the budget or the vote on account to kind of really play out, and that's when I think the transmission of lower rates will start to happen, number one. Number two is if you're going to see some kind of a fiscal slippage, or you're going to see some kind of cash transfers happen and all of that, the loan waivers which have begun to happen, clearly I think these two will act as some kind of a demand stimulus. So it's quite possible that the December quarter will be weak, and that could create some kind of buying opportunities where stock prices could be lower. And this demand slowdown could be a bit of temporary. It could just be a pause in demand. But post the rate cuts, post the stimulus, it's quite possible that Q2, Q3, Q4 of this calendar year could be a lot better in terms of demand. And therefore, consumer discretionary is the space to be. So clearly, number one, I think, of course, is basically the home developers. That's one segment where they're below radar, and there is still some kind of caution prevailing. But I clearly believe that that is going to create, that is an opportunity. Number two, some of the consumer appliances stocks, they have been battered down, especially in 2018 has not been kind to that segment. Yes. So you clearly see there as an opportunity. Again, the December quarter could be weak for them, but that itself should be looked as an opportunity.
What kind of an earnings growth are you looking at for the market? What kind of valuations at a market level, 16 times, what will you be comfortable with?
Probably, I think around that another 5 to 10% fall will really make the valuations very attractive. But yeah, I mean, I think sub 20, I think there would be value. There'd be a lot of pockets of value. Next financial year, I think should be good from an earnings outlook point of view.